This is the Group 7's video presentation for the Chapter 12, Return Risk and the Security Market Line. And my part will be focused on different returns and different kind of risks. The first part is the return. The return of the stocks can be roughly divided into two parts. The first part is the expected return, and sometimes called normal return. This part is expected by investors, which depends on the information about the market and the investors' understanding of the market. For example, investors can know how many restaurants McDonald's has opened around the world, and can roughly predict how much revenue this restaurant can bring to McDonald's. And the second part is the unexpected return, which is uncertain and risky. This part is determined by the unexpected information disclosed in the market, which may be positive or negative. Take McDonald's, for example, again. Recently, due to the supply chain problems, McDonald's in Japan can't get enough potatoes to make the French fries. This increased the purchase cost of McDonald's potatoes and may affect McDonald's sales. For McDonald's, this is a negative, unexpected return. Now we can write the equation. The total return equals to the expected return plus unexpected return, and the mathematical expectation of the unexpected return is 0. Then at this time, the total return is equal to the expected return. Now we will discuss two important factors that will affect investors' expected return, and the announcement and news. Actually, I don't think all announcements belongs to news. For the listed company, they are required to publish some announcement periodically, including the monthly, quarterly, semi-annual report and the annual report. In addition, when the company makes some major decisions, it will also make some announcements. However, many times the information conveyed by these announcements is not brand new. Take a company I invested in last year as an example. The board of the shareholders of that company passed the resolution of the private placement of new shares. In the following months, the company issued several announcements on the progress of their new share issuance. These announcements were in the expectation of investors, so they did not cause significant fluctuations in the stock price. When we consider the possible impact of an announcement, we cannot simply judge the significance of the announcement through loss or profit. We usually need to combine the previous announcements with the news and the latest announcement. When the negative content involved in the new announcement is better than investors' expectation, this information can be regarded as good news. A typical example is that on April 10th last year, Alibaba was fined $2.78 billion for violating the China's antitrust law. And the next trading day, Alibaba's share price rose by 6.89%. And in the view of Ali's investors, the fine of $2.78 billion is actually better than expected. so this is regarded as good news. And let's look at the following equation. The announcement equals to the expected news plus surprise news. As we learned before, the efficient market hypothesis in the semi-strong market or the published information has been reflected in the current stock price. Therefore, only the surprise part of the announcement can be regarded as the real news. And the next section is about different types of risks. If we always get the expected return, the result of investment will be completely predictable. In fact, investment is risky, and the source of risk is the part beyond expectation. Risk is mainly divided into the systematic risk and the unsystematic risk. The systematic risk, also called as market risk, usually affects most companies. The causes of the systematic risk include the macroeconomic factors such as GDP, interest rate, and the inflation rate. The unsystematic risk is also called firm-specific risk or the unique risk, since unsystematic risk only acts on one or few companies. This risk can be reduced by diversifying investment. In fact, I personally think that sometimes there is no obvious boundary between the unsystematic risk and the systematic risk. In a highly leveraged market, if the risk generated by a single company is large enough, it may also bring systematic risk to the whole market. And now we can summarize the previous theory through an equation. The return minus expected return equals to the unexpected return. And the unexpected return can divide into two parts: the systematic portion and the unsystematic portion.
Okay, after knowing about how to calculate the beta for the portfolio and the expected return for the portfolio, let's come to the next part, which is the reward to risk ratio, and it's also called the Torino ratio. And for this ratio, the formula shows here, and the calculation for the SSA shows here. The 7.5% reward to risk ratio for the SSA, and that means the SSA offers a reward to risk ratio of 7.5%. Or say that SSA has a risk premium of 7.5%. And that could be a reward or say the compensate for the investors who could bear in the systematic risk. And we always consider that for the ratio, it's the higher the better. And here this figure shows that the slope of this figure is the reward to risk ratio for SSA and 7.5%. Then let's come to the practical use of this reward to risk ratio. Here two assets for A and B. Since both of them have their own pros and cons, we cannot directly compare which one is better. So it could come to the reward to risk ratio, and the same thing, calculate the reward to risk ratio for assets B, and then put assets A and assets B together. We could find that the reward to risk ratio for SSA is higher than SSB. So in this case, we consider that the SSA is better for us to invest. Okay, next part about the properties of a reward to risk ratio. Since previously we know that SSA is better and the investors will be attracted to purchase SSA, and still simply demand a supply principle that demand for SSA will increase and the price for assets A will also increase, which means the expected return for assets A will decrease. Remember that these two things always have an inverse relationship, and automatically these two things, as assets A and assets B, their reward to risk ratio will become the same. That is, the reward to risk ratio must be same for all assets in a competitive financial market. Here, competitive also means an active or say well-functional market. And this situation just illustrates the points we mentioned before, that A and B, they are on the same line, which means they have the normal reward to risk ratio and they are same. While here for assets C and assets D, they do not on this line. And for assets C here, its reward to risk ratio, or say its expected return is a little bit higher, which means its price will increase soon, and its expected return will decrease, and automatically C will fit in this line. And the same thing happens to D, that it will fit into this line. Okay, next part is the security market line. It's a graphical representation of linear relationship between the systematic risk and expected return. Here is the market portfolio, and the beta for market portfolio is 1, so it eliminated this part, it will come to this one. And when combine the previous knowledge we learned before, we could find this capital assets pricing model, which is the most important thing we need to know in this chapter. And the formula is easy, and we all learned it in our corporate finance. So only one thing we need to pay attention to is when dealing with the problems, sometimes the problem will provide us this expected market return. So we need to subtract the risk-free rate and then get this whole thing. But sometimes it will directly provide us market risk premium. The whole thing is called market risk premium. So when dealing with the problems, we need to pay attention to this. If we make a mistake here, the whole calculation could would also have some error. Okay, and the last one is just the security market line, how we came to this. Originally, it has a beta here, but for the market portfolio, the beta equals to 1. So here, the slope of the security market line is equal to the market risk premium. As we discussed before, the expected return subtracts the risk-free rate. Okay.
I will introduce more about beta. We combine the first formula and the second formula, and then we got the third formula. From this table, we have R and RM, so we can calculate the unexpected returns on the security, along with the unexpected return on the market as a whole. The results are shown in columns 3 and 4. Suppose a particular security have a beta of 1.2. Next, we calculate the unexpected return on the security. That is, we break them down into their systematic and unsystematic parts. On unsystematic parts in columns 5 and 6, notice that the unsystematic part is whatever is left over after we account for the systematic parts. This graph shows the main points of this discussion by pointing the unexpected returns on the security in the last table against the unexpected return on the market as a whole. These are the individual points in the graph. We also point the systematic parts of the unexpected returns in the last table and connect them with the straight line. Notice that the slope of the straight line is equal to 1.2, the beta of the security. As indicated, the distance from the straight line to an individual point is the unsystematic part of the return for a particular year. So, where do betas come from? As our discussion to this point shows, beta is a useful concept. It allows us to estimate the expected return on a security. It tells how sensitive a security's return is to unexpected market events. and it lets us divide the systematic and unsystematic parts of a securities return. Above, we were given that the beta was 1.2, so the required calculations were operated straightforward. Now we come to the part that's new. In the last column of the table, we have calculated the product of the return deviations by multiplying columns 3 and 4. When we total these products and divide by 4, the result is called the covariance. Also, we can use Excel to calculate beta. If you use this function, be sure to select the market returns as the X data and the security return as the Y data. When you do, you will find that the result is the securities beta of 0.9. Recall that beta shows relative movements. For example, a security with a beta of 1 is expected to move on average with the market. In this case, what would the characteristic line look like? It would be a line with a slope of 1. This slope indicates that as the market goes up 1%, we would expect that the stock to do the same. In mathematical terms, the measure of rise overran is slope. So if we define that the market as the X data and the stock as the Y data, the slope is the beta of the security. Notice that when the market has a return of 10%, the security is expected to have a return slightly less than 10%. The characteristic line thus suggests that the beta for the security is less than 1 because the stock return is less than a corresponding market return because the core movement in returns seems to be rather close. However, our answer of 0.9 seems right. Hopefully, you remember this as a simple linear regression. In this case, we are going to regress the return of the security on the returns of the market. From this figure, we can see that the security have a positive relationship with the market. To capture the nature of this relationship, consider figure B, which adds a simple line to the data. We refer to this as the characteristic line. Notice that the line almost crosses as the orange. Excel also have a built-in regression function. If you look at the spreadsheet analyze box, you can see that the output from this process. You will notice that the output provides an estimate of the intercept as well as the slope on the market return. You should think that the estimated value is 0.9, which is consistent with our earlier calculations. Based on what we have studied so far, you can see that the beta is a pretty important thing. Anytime we use the past to predict the future, there is a danger of a poor estimate. As with any financial tool, beta is not a black box that should be believed without question. The previous two sections introduced you to the famous capture assets pricing model, or CAPM for short. What you earn on your portfolio over time depends only on the level of systematic risk you bear. As a diversified investor, you don't need to be considered with the total risk of any individual asset in your portfolio. It's irrelevant. A little kind of researchers questions these general principles. Is inappropriation to look at the risk of an individual security. What it writes is how the individual security contributes to the risk of a diversified portfolio. We now briefly explore the FF3 fact model. The F and F3 fact model is an asset principal model developed in 1992 that explained on the CAPM by adding size risk and value risk factors to the market risk factor in CAPM. This model considers the fact that value and small cap stock overperform markets on a regular basis. As shown, two groups of stocks have tended to do noticeably better than the market as a whole. The first one is stocks with small cap stocks, and the second one is stocks that have a higher than average ratio of book value to market value of equal. First, for each year of historical data, each of a large number of stocks is ranked on the basis of its market cap or size. The smallest 20% of the stocks are placed into the market cap. The next smallest 20% are placed into market cap quintile 2, and so on. Then the same stocks are ranked on the basis of their book to market ratio. Here is our reference, and these are review of this chapter. That's all. Thank you.